E-mini has been working up for the past 6 days. Today's the 7th day, but it's a type of a wedge, a small wedge. We have bull, doji, and then we went up and down, up and down, up and down, and it's narrowing. And I bring this up because of this biclimax. Whenever you have a biclimax and then you get even a small wedge like that, it can lead to a surprisingly big pullback. We had it on the weekly chart. I keep talking about 2003. The pattern back then on the weekly chart over here, late in the bull trend, a biclimax, and then a small wedge top. We had a big bear bar and then 40 bars, 30 or 40 bars of sideways to down, testing down here to the breakout point. So biclimax wedge, and on daily chart now, biclimax wedge, the breakout point is down here. That's an obvious target, so let me put a little line there. It's around 2,500. Traders have been selling above bars over the past couple of weeks. We've been getting, testing the high, sell off, sell off, sell off, sell off. And today we're trying to rally above the prior all-time high and, see what happens. Traders have been selling at the highs. Bulls have been taking profits and bears have been selling. We're at an increased risk of a big trend day, up or down. And the reason I say even up is because more down is more likely. This is so climactic on the daily chart, weekly chart, monthly chart. You look at it and say, well, it can't keep going up. And therefore traders will start taking profits at new highs and bears will start selling at new highs. And that makes it impossible for a big bull trend day. Well, it increases the chance of a black swan event. A black swan event is an event that people think is impossible. Before anyone saw a black swan, they assumed they could not exist, but they did exist. And whenever you look at something and you assume something else is impossible, and you behave with that assumption that this other thing is impossible, you set yourself up for a loss. And even though a top and a big reversal down is more likely than a big upside breakout from here, when the market's already extremely overbought, it always increases the chances of a huge bull breakout, a climactic end of the trend. It's still not likely, but I think this week has an increased chance of either a big day up, which I think will reverse down, or a big day down, one of these days. First bar of the day, traders want to see how it closes. Is it going to close above Friday's high? Is it going to close on the high? Is it going to have a 2 or 3 tick tail? We're trying to get a sense of what the day will be. Right now we're opening on the low, but I discovered on Friday that TradeStation uses sampled data and they don't show every tick. And in fact, the open might not be on the low. Chances are we're going to trade below the low, because the market has been selling off on the open over the past few days. This bar so far is holding up above Friday's high fairly well, but until the bar closes, I think it's wrong to draw a conclusion, because in the final seconds it can completely reverse. All right, so close above yesterday's high, so Friday's high, so close at a new all-time high. And I've mentioned several times that we have a breakout test here, a pullback to this breakout point, and a sharp reversal up from there. So this price is very important. A major higher low, very important, and that means the measured move up is very important, and that's at 25.59.5. So 3 points above where we are is a very important price. So we might get there today, and it'll be interesting to see what happens. I hope you understand what I'm saying, that the market sold off strongly on this day and reversed up strongly, just a couple ticks below this point after a breakout above that point. So the market's telling us that this is a very important point. It pulled back to it and reversed up violently, so the market thinks it's a very important price. And that also makes it likely that it will have to get tested again. Also, it just dipped a tick or two below the price with a big tail on the bottom. And normally if you have a big tail on the bottom of the bar and the bar only dips a tick or two below support, the market has to come back and test that support, before it goes too far up. So this would be the first reasonable target if we do get any kind of reversal. Okay, so the bulls who bought on a stop one tick above Friday's high are concerned that there's a tail on the top of one, and that 2 has dipped below the one high, and so far 2 has a bare body. However, until the bar closes, you don't know, right? Because a lot of times you'll have bull bars that were bare bars while they were forming, and then in the final seconds they buy it into the close, and all of a sudden you have a bull bar closing on its high. In terms of patterns on the 5-minute chart, very strong rally, and I talked about how we have a big high 2 legs down, 1 pullback 2, and a reversal up, but the reversal looks terrible. We're getting deep pullback, deep pullback, deep pullback. This entire rally looks like it's a bull leg in a trading range, and therefore it should lead to a bear leg in the trading range, and the bottom of the range probably will be right here. So right now I think we'll probably pull back here within the next few days. Right now, this is similar to this: gap up, pullback, gap up, pullback. Here, gap up. It looked like a reversal, but it held above the low, so it was a gap up, pullback. It took a couple days to get back up to the high. If 2 closes on its low, it's a reasonable sell. Is it a high probability sell? No, but it's a possible high of the day, but it would have maybe a 25% chance of being the high of the day if 2 closes on its low and then 3 trades below the 2 low. Final seconds. Okay, 1 tick tail. So that's okay for swing bears. Higher probability, wait to see if we get a few consecutive bear bars, or wait to see if we trade below 2, go to a new high, and then reverse down the second time. For the bulls, 2 is a pullback from the break above Friday's high. So it's a high 1 buy signal bar, but a tail on 1 not all that big, 2 big bear body. Not a lot of bulls eager to buy above 2. We're always in long. We reversed up fairly strongly, and daily chart we've been rallying in a channel for 6 days, but not strongly bullish. We're not getting big bull trend bars closing far above the high of the prior bar. We keep reversing down. Every time it goes up, we sell off. And sell off, big tail on top of the bar, big tail on top of the bar, bear bar. So less bullish than it was 3 weeks ago. This is 3 weeks ago, and now the bulls are taking profits every time it goes up. Looks like the bulls are probably going to get to that measured move target today, or at least test it. Normally, on a 5-minute chart, a test requires that the market gets to within 1 tick of the target. And on the daily chart, a test could be even a point or two below the target. If you get a reversal, that could be the extent of the test. It's likely that we're going to go at least a little bit above that measured move projection. This rally is extremely strong, even though for the past 7 days, we're in a wedge channel. We're so close to the target, and we have a lot of momentum. Traders sold the one high, did not make money. They wanted to sell. Actually, they did make money. They sold the one high and 1 point higher, and they made money. So that might encourage them to sell the 2 high and the 1 high. Most traders, I think, better to be flat. If 1 closed on its high and then 2 had a decent bull body closing on its high, even if it was a small consecutive pair of bars like this, traders would buy the close looking for at least a 1-point scalp. And we do not have that yet. Friday, small day, and that increases the chances of an outside down day today. But if we go up 2, 3, 4 points above Friday's high, then the odds of an outside down day become a lot less. You can see we're getting drawn up to the target. Target right here, 25.59.5. This is, I think, really important. We pull back and we reverse up violently. That tells us this is a very important low. You look to the left, we had a very important high, and therefore this price is very important. And this is obviously very important, a major higher low in a bull trend, and that means this is very important. 3 did not fall below 2, and therefore this is not a second entry sell for the failed breakout above yesterday's high, Friday's high. It's a first entry sell. So it's slightly lower probability than it would be if 3 first triggered the sell below 2. You can see not a lot of traders buying the breakout. Let's say it's a 3-tick bear body closing on its low. That would be a reasonable sell for a possible high of the day, for a possible outside down day, looking for the market to fall below yesterday's low. We had a day over here, traded 10 ticks above yesterday's high, sold off, and then traded 9 ticks below yesterday's low. It went sideways for most of the day, but it became an outside down day. So this is the kind of thing that I'm talking about today, that we break above yesterday's high, and then reverse down, and at some point trade below yesterday's low. You can see we reversed back up at the end of the day. Let's say it's a 1-tick tail, a 1-tick bull body, 1-tick bear body. So let's say 1-tick bear body. That would lower the probability for bears taking the short, but I still think it would be a 25% chance of a high of the day. So it's an okay short. Traders wanting higher probability, they wait to see 1 or 2 big bear bars closing on their lows, and then they sell. You get the sense that you're waiting for the close of every bar before you get any certainty. That is trading range type trading, where you you feel like it's constant uncertainty, and it increases the chances that we're not going to go very far up or down. It reduces the chances of a big trend day. We still have 7 ticks up to that target on the daily chart, and I think that target is so important that we're going to have a hard time reversing down unless we get there. We're probably within the gravitational field of it, and if you have a powerful magnet and you hold some metal close to it, the closer you get, the stronger the pull, and at some point you can't resist the pull. The market has to get there, and then there's no more pull. So a bad sell signal bar. We have bad follow through after 1 and 3, but not a good sell signal bar. Plus we have a magnet above. So the possibility of an outside down day is still real. But right now, I think enough computers see what I see, that there's an important target above, that a lot of traders are unwilling to sell unless we get up there, or unless we reverse down strongly. Weak rally, so probably not going to be a big bull trend day. The bears so far have not been able to create a strong reversal, probably not going to be a strong sell day. We have a magnet above. Because it's a daily chart, this could be as close as we get to the target, although I think we'll probably get closer, if not today, then soon this week. And because another mostly trading range day is likely, like the past 6 days, whenever the market is high, traders start to look to sell. And we're high. I don't know that this is going to be the high of the day. We may have to go higher, but the bulls are failing to turn it into a bull trend day. And therefore, whenever it gets high, traders start to look to sell. It gets high, look to sell. High, they sell. So it makes me think that this rally is probably going to stall soon, and that we'll either enter a trading range up here, or this whole thing will be a trading range, or we'll start to reverse down. Whenever you have a weak rally, and it looks like a trading range is likely, there's always a possibility that the rally will continue for hours and become a small pullback bull trend day. But the odds are against it, especially given this context of 7. This is now the 7th day in a tight channel. Not a good buy signal bar 1. The bulls who bought above 1, the bulls who bought above 2 did not make money. The only person to make money, well, I was going to say the only person to make money so far is the bear who sold 1 point above yesterday's high. But, you also had the bull who bought the 2 close, betting that there would be enough buying below 2 so that we would not reverse down. So, but neither case, in both cases, it's limit order traders making money, not the stop order traders. 5, a better sell signal than 4, but it would be better that the first bar, bar 4, form the bear bar, because that would represent more urgency on the part of the bears. So also now we have a 5-bar bull microchannel, obviously very weak, only 2 bull bodies in the 5 bars, but it's a 5-bar bull microchannel, and that increases the chances that there are more buyers than sellers below 5, even though it's a sell signal bar for a failed breakout above yesterday's high. Most traders should just wait. Possible high of the day without much risk, but if it is going to be the high of the day, the market will let us know within the next several bars, and waiting for those bars will lead to a higher probability trade. can see, the bears don't want to short after a 5-bar bull microchannel, knowing there's a magnet above. And the bulls do not want to buy because we have 2 bear bars closing on their lows, and we're above yesterday's high, and traders have been selling above highs for the past week. Confusion, right, increases the chances of a trading range open. High one buy, but with 3 bear bars in the first 6 bars today, traders are hesitant to buy with stops. Also, 6 bars into the day, now 7 bars into the day, stop entry traders have not made money buying or selling. So most traders should wait. What would be good for the bears is if we get one more push up and then a second sell with a decent sell signal bar. Then maybe we'll get to the target on the daily chart, and we would have a second entry short failed breakout yesterday's high. Many different flavors of it. Strong breakout yesterday's high, tried to reverse down, and then we got a micro double top. Bears got a swing down. Tried to reverse down a second time, and sold off all day. Tried to reverse down once, tried to reverse down a second time, but a doji bar. A lot of traders would rather sell below the bear bar and enter here. Reverse down from above yesterday's high, and that's actually the second entry. The first one was here below this bull bar, and then the second one's below the bear bar. Tested back up, could not get above the stop, and the bears got a swing down. Reverse down, and then a second entry. Did not get above the stop, and got a swing down. Probably 25 to 30% chance this is the high of the day. So 25 to 30% chance we'll sell up from here, and as I said before, the obvious target is yesterday's low. So that means 70 to 75% chance this is not the high of the day, and it will go a little bit higher. However, every tick down that we get increases the probability that this will end up as the high of the day. Higher probability if we get one more new high and then reverse down a second time. That gap will close in the next minute or two. While sometimes gaps remain open on the 5-minute chart, it's maybe once every 2 or 3 years. Usually they close right away, like this one just did. Bulls now hoping for a double bottom with 1 at the moving average. We had 2 legs up, 1 pulled back 2, 2 legs down, 1 pulled back 2. So bulls are hoping for a double bottom and a early low of the day. The bears are hoping that they've seen the high of the day. Bar 9 is important. If it's another consecutive bear bar, it increases the chances that we'll trade below yesterday's low. Gap up, sell off, double bottom at the moving average, low of the day. Gap up, sell off, double bottom, low of the day. This is a double bottom here. It's more of a wedge sell off, but this is more like today. Gap up, double bottom. That's what the bulls are hoping we'll get here. Gap up, double bottom at the moving average, low of the day. Probability is still not all that high. We're getting reversals every 2 or 3 bars, so that is a trading range open, and that makes buying or selling for a swing a low probability bet. Stop order bears made money below 5, which is good, and the scalpers made money. The swing traders can still be holding short, but here's their problem. Their stop is up here, so they're now risking 7 ticks, hoping for a swing down here. What's their probability right now? I don't know, I would say 50-50. By the close of bar 7, close of bar 8, usually 50% chance you've seen either the high or low of the day. So right now, 50% chance either this is the low of the day or this is the high of the day. Are we always in short yet? I think the bears need one more bar. You know, they had a weak entry bar 6, bad follow through 7 and 9, and we have a potential double bottom at the moving average. I gotta fix one of these things here. This one. Good bar for the bears, especially if they can close down here. It lowers the probability that we're going to get a double bottom and early low of the day. Increases the probability that we're going to have an outside down day. Bulls hoping parabolic wedge, 1, pullback 2, pullback 3, and the bears want a measured move down and a break below Friday's low. Do you think bulls would buy the 1 low? Of course, right? We've had multiple reversals for the first 9 bars, and a lot of traders will bet that it will continue. Also, the bulls are hoping that this is a small version of what we got last week, gap up and a very deep pullback, and then an early low of the day. Here, gap up, deep pullback, and became the low of the day. We had to get a double bottom, but parabolic wedge, 1, pullback 2, pause, and then 3. These are examples of first reversals down from yesterday's high. Always in short, testing 60-minute moving average and yesterday's close. Can you buy here? Well, I think the math might be okay if you're a computer and you can manage it, but I would not. We may go sideways here. We're at obvious support. You know, we're a measured move down, 60-minute moving average, yesterday's close. But right now, always in short, and probably 70% chance we've seen the high of the day, and this may go sideways. Sometimes when you get these big moves, you go sideways for a lot of bars, so this is probably what we're going to be doing over the next hour. Here, we went sideways for 4 hours after the reversal down, got to the close of yesterday and the 15-minute moving average. So this is probably what we're doing. We're probably going to be going sideways here. What happens if we get a 1-tick bull body or 2-tick bull body? It's still possibly a pullback from the breakout above this bear channel, but I think most traders think it's always in short, and they look to sell a rally rather than to buy above 11. We're also in the final bar of the first hour. The bears want as bearish a bar as they can get. They want the bar to close on its low, but look at to the left, right? 7 dojis, and buyers below everything, sellers above everything. And this is telling us that the first hour today is similar to all of these other bars, that it's more likely we're going to be sideways. 8-tick bounce, that's bad for the bear case, and it makes it likely that we've just entered a tight trading range. What about the low of the day? I think we're probably always in short, just the size of 10, 11. But, this is bad for the bears. You don't want a big reversal up from the 60-minute moving average and yesterday's close, and it increases the chances that we're going to be sideways. Always in short, so that means we're probably going sideways or down. $18 ticks below 5, so a lot of the bears got 4 points and were down to support, and they took profits. But probably sellers above, arguably sell the close, but your stop is all the way up above 4, the high of the day. And bulls, that reversal up from support is big enough so that they probably will be looking to buy below bars, at least for a scalp, betting that a tight trading range is more likely than the market falling straight down from here. And they are correct. Most likely, we're going to be going sideways. We're probably doing something like this or this. Remember, there were limit order bulls who bought the one low, and they bought more 1 point lower, 2 points lower. And right now, I suspect they will make money. So I think we're going to get back above the one low and then enter a trading range. Breakout pullback short, but because it has a bear body, a lot of bulls will not buy below 12. And with that big tail on the bottom of 11, a lot of the bears will not sell below 12. So we might be entering a very tight range here. Bar 12, end of the first hour. It's a bear reversal bar, but nothing to reverse. The market's going sideways. Because it's a bear reversal bar at a new all-time high, we might have to trade below its low, but I think it's not a great sell, even though we're always in short. That tail on the bottom of 11, I think, is a warning that we're probably entering a tight range. I said today might become an upside down day. This week might become an upside down week because last week was small. It's also a parabolic wedge. Rally, pullback, rally, pullback, rally. This is the weekly measured move target. I think it's less important than the daily measured move target, because the daily measured move target has a very clear violent reversal up from a very important price. So the daily target is based upon two very clear prices. The weekly chart, it's less clear. We have a pullback here to that breakout point, but I think it's just not as clear. This breakout point, the top, is not all that significant. The bears did not sell off strongly from this price. Can you buy with a stop? I don't know. If you're buying, it's better to be buying with limit orders. I think we're always in short. Is there anything the market can do to make traders buy with a stop? I don't think so. And for the bears, they don't like that big tail 11, and they probably want to sell above bars. Right now, I think there's a 50-50 chance we're going back above the low of 1 within the next few bars. And that's part of the hesitation here. The bears want to see what the bulls can do, and so the bears are holding back on selling. They're ready to sell, but only if we start to turn down sharply. For the bulls, it's simply a deep pullback from a gap up and a rally. They have a micro double bottom at support, but not much in terms of buying pressure. So a lot of bulls will not buy with a stop below 13. And the bears don't want to sell. We've reversed up twice here. Moderately strong reversals, moderately big tails, but not strong enough to encourage a lot of enthusiastic buying, and the tails are a problem for the bears, and they don't want to sell. So nobody wants to buy, nobody wants to sell. The result is probably going to be sideways. Bulls trying to prevent 14 from falling below 13. 13 is a pullback from the reversal up, and 1 bar pullback. The bulls are hoping that we get a channel up from here, but if you get a second bar, in other words, if 14 falls below the 13 low and creates a second pullback bar from this reversal up, it reduces the chances that we're going up. So the bulls are buying right here, trying to prevent 14 from falling below 13. And they want, as I said, there are limit order bulls who bought the 1 low, and they bought more lower, 1 point lower, 2 points lower, and they're trying to get back above the 1 low. And I think 50-50 chance they will do it in the next several bars, creating more confusion, right? Trading range open, bull breakout bar 1, but big tail, bad follow through 2, and then same thing with 3, 4, reversal down on 6, bad follow through 7, bear breakout 8, bad follow through 9, and then 11, 13, big tails below. Not behaving like the start of a trend. It's behaving more like a market that is starting to go sideways. Bears getting another push down. We went, 9 ticks above Friday's high, so there's support around 9 ticks below Friday's low. Bulls will try to get a parabolic wedge bottom out of this. But a lot of tails and dojis here, not a lot of traders willing to take that sell right at the 60-minute moving average. I bought on 13 and then get out break even. I bought 2 ticks below, where did I buy? Maybe 1, I bought at 53, 20.53 even, and I did not like the follow through 14, and I got out. I think it's a limit order market, but I don't like it continuing down like this. Do I still think we're going above the one low? I think at some point today we'll probably get above the one low. Bears are trying to get outside down, but a lot of tails. We're not getting bull bars, but to me this is a lot of tails. It increases the chances. It makes it more likely than not that we're going to bounce before we go below yesterday's low, if we go below yesterday's low. Higher probability buy if it closes like this. And the theory of the buy, you call it a double bottom at the 60-minute moving average in yesterday's low. And it's also a wedge, even though 16 did not fall below 11. And then there's also that 18 bar range that I talk about. This is bar 16. We're getting near bar 18. And by the close of bar 18, there's a 90% chance we've seen either the high or low of the day. If the market's low around bar 18, the bulls will buy a reversal up, hoping that we are getting the low of the day. The risk is small relative to the reward. They're hoping to get all the way back up. They're looking for a reversal day all the way back up to the high of the day. Plus we have the magnet of the low of 1. And you have scale end bulls theoretically who buy the low of 1. And instead of buying 1 or 2 points lower, they buy the low of 1 and then wait for a bull bar like 16 and buy more above 16, trying to get out, break even on their first entry, and then with a profit on their second. Usually you want the second entry to be at least 2 or 3 points below the first, but if this is going to be another one of those really small days, that might not happen. Now for the bears, they want a double top with maybe 13 and 17, but the context is good for the bulls. It's basically a type of a wedge bottom at support and from a higher low. It is a little bit similar to that gap up bottom that we had last week over here. Gap up rally, and then a second reversal up, so went up, and then a third reversal up, and it became the low of the day without going below the prior day's low. The bears wanted outside down after such a strong reversal down, but the bulls held the 60-minute moving average, and it became the low of the day. Can you sell outside down here? Can you sell on the stop below 16? Well, I think the bulls will exit below 16, and I think the bears are hesitant to sell at this price. We keep getting buying around here, so I think it's a difficult short. Still always in short, but if we start to get a series of bull bars, that will change. So it's still slightly more likely that we're going down than it is that we're going up, but it would not take much. So what do the always in bears do? I think they get out above 16. Theoretically, they have to sell again below a bear bar, but I would not sell below 17. I would wait to see if we get a low 2 short. So 17 is a low 1. If we get a low 2, then sell. If we get a big outside down bar, maybe sell or sell below the outside down bar. It's still on the buy above 16, so 18 is an important bar. Are the bears going to get a big bear bar, increasing the chances that we're going to go outside down below yesterday's low? Or will the bulls start to form a channel? We get a 1 bar pullback and then another high and another 1 bar pullback, and we start channeling up like this. That similar day over here became basically a trading range day. We got a reversal, but did not get back up to the high of the day. This is actually a fairly common pattern. gap up wedge. Sometimes you get really deep pullback like this. This is from the other day. Here's another gap up wedge. Now, I know I have another example somewhere, but I don't have it here. I don't know where I have it. Gap up wedge. So what do the always in bears do? I think it's hard for them to do something here. I would rather take a second entry short, but they have to get short again if they're trading always in. So, theoretically they're selling below 18 if it's a bear bar, but I would not do it. I think we're probably in an early trading range. Bulls buying at and just above 16, trying to keep their buy alive. And bears know the bulls give up below 16, so the bears are trying to get below. Is this a major reversal? I don't know. I think it's more of a minor reversal in our trading range. We've been sideways here, and there's not much to reverse. We sold off for about 10 bars. That's not a major bear trend. It's probably a bear leg in a trading range, and the market is now looking for the bottom of the range. And therefore, just like we had a bear leg in a range, if we go up, it'll probably be a bull leg in the range. Targets, if we do bounce, the one low is, I think, an obvious one. If we do bounce, we have a small double bottom, 16, 18, neckline, 17, and it takes us exactly back to the all-time high. So, low of 1, all-time high, also a 50% pullback, but if we get the 50% pullback, we'll probably get to it is right around the low of 1. I was going to say the low of 1 is probably the most important magnet. Actual risk for the bulls who bought the 1 high is 1 tick below 18, so that's here. And 1 times actual risk is in that same general area around the 1 low. It's a ledge top. We have 3 or more bars exactly at the same price. It's a ledge, and we have a ledge bottom, breakout mode, just like this looked like a bull leg in what would end up as a trading range. This looks like a bear leg and what will probably end up as a trading range. Remember I said that a lot of the always in bears would not sell below 17, but if they get a low too short with a bear bar, they would sell that and so they might get that bar 20. Would they sell with a 1-tick bear bar? Probably not. They probably need a 2 or 3-tick bear bar closing on its low. Even then, it's not a very good sell. We have a ledge bottom at support after a weak sell-off. Bad follow through, bad follow through, bad follow through, and we have a magnet above the one low. So I think the bears are better off trying to sell higher or selling after they see a strong breakout below the low of the day. Are we always in long yet? Not yet. We don't have to go up, we don't have to go down. We can just go sideways, which is what we have been doing. I think it's more likely than not we're going a little bit higher, but I'm not sure that we'll get above the high of the day. Well, the bears are low 2, but bull body 20, middle of a tight trending range. So still always in short, but the bears need a better sell. Probably we're going up a little bit. We don't know if we'll go up a lot. If we start to get 3 or 4 consecutive bull bars, even if they're small, then we're probably back to always in long, but probably a bull leg and a training range like this. 3 bull bars and then a 4th one here. We got a second leg up, but it became a very quiet day. Bears trying to get a bear flag below the moving average, hoping that this is the start of a bear trend where the market just keeps selling off at the moving average. Bulls could not get above the moving average here. We went lower and then they got above. Stalled at the moving average, stalled at the moving average, finally broke above. With the consecutive bull bars 19, 20, a lot of bears will not sell below 21. We have a good reversal 16, and then we have a pair of good bull bars 19, 20. Increases the probability that there are buyers below 20 or 21, even though it could be a bear flag below the moving average. So I still think the odds are buyers below. Let's say 21 closes on its low at the 20 low. Then I think bears would consider selling. Final seconds. Okay, 1-tick bear body, probably going at least a little higher. It's hard to say that it's always in long when we're not above the moving average yet. So it's still slightly more likely that when we do get trend resumption that it'll be down. You can see all the bulls just giving up right there. A low too short below the moving average, a bear sell signal bar. Always in bears, theoretically have to sell again. It's a second entry sell, 17. I said a lot of the bears would not sell below 17, but they would feel compelled to sell if they get a second entry short with a bear bar. I thought they would want a better bear bar than that. And, I just don't know. We'll see what happens. I did not sell below 21. I did buy during 18, but I'm back to flat. So a really interesting bar. It suddenly became very big, 3 ticks, which to me was a lot of the bulls panicking out. In general, if you buy what you think is a low above 16 and you think it's a reasonable bottom, you'll rely on your stop and you'll allow the market to go against you one time. But unless the market becomes clearly always in long, you don't let it go. You do not let it go against you a second time below 21. And that's why low 2 shorts with bear sell signal bars tend to work well. They tend to have a high probability because you got the bulls giving up. This is, I think, a special case. It's much more of a tight trading range and much more of a neutral market. So a lot of the bears, I think, will not sell with a stop below 21, and a lot of the bulls will keep their stop below 16. I am currently flat. If I was still long, I would have gotten out below 21. Low 2 at the moving average, just below the moving average, with a bear sell signal bar 21, closed below the moving average. When you look at it, you have to conclude it's neutral. A 10 bar tight trading range at support and at wedge bottom, so good for the bulls, but strong sell off and below the moving average, so good for the bears. Tight trading ranges trump everything. They're always the most important thing on the screen. And in other words, it's more likely that the tight trading range will continue to add bars than it is that a buy signal or a sell signal will be profitable. Another bull bar closing on its high, increasing the chances that we're going to get up to the 1 low. And the low 2 bears, always in bears who sold again below 21, they'll get out here above 21, so we may end up getting a measured move up here, which would be back to the all-time high. And it would only take 1 or 2 more bars to make the bears give up and for traders to believe that we've seen the low of the day. Might get a gap here, and the market could become always in long. Unlikely to become a big bull trend, but it may be the start of a swing up, a weak rally lasting a couple of hours. It's probably going to be one of these days where we go up for a while and then still mostly sideways. Less likely, we'll get a protracted tight channel. Reversal day, sold off, reversed up, but not all that strong. Wedge bottom, a lot of sideways trading. Never got back to the high, never got back to the low. Are we always in long yet? I think we probably are. The bears, I think, are giving up. We're above the moving average. We got consecutive bull bars, 19, 20. The bears had a low 2 with 17 and 21, and it failed. Again, I'm not expecting a big bull trend, but I think it's more likely that we're going at least a little higher than it is that we're going to go to a new low over the next 5 or 10 bars. This is the end of the second hour. First hour bear reversal bar, but nothing to reverse. 8 bar tight trading range. And this hour, another sideways bar, so 9 bars in a very tight range. Not a lot of bears willing to sell above 21, but 23 so far, not very big. Some bears will sell it as maybe a small wedge with 17 and 21. We had a double top, and we're getting a bull breakout. In general, 50% chance a breakout above a double top will fail. I think it's slightly less than that here. Today's probably a trading range day, and we're probably near the low of the day. And the bears have made many attempts to get below yesterday's low, and they keep failing. So they should not have allowed it to get above the low 2. That was their time to take control, and they failed. And I think that lowers the probability that they'll be successful below 24. 3 consecutive bull bars closing around their high. 5 out of the past 6 bars. I think always in long, but I do not think it's going to be a strong bull day. Tomorrow 24, the close of the second hour, closing on its high. You can see it's a bull inside bar. However, we've had many bear bars and bull bars, and the market has not gone far up or down. So not a strong buy setup. Strong enough breakout, probably at least a small second leg up, and therefore a low probability sell. You can see the limit order bulls. They want to get one tick above the one low, and the bears are trying to trap them, trying to force them to sell out. I still have contractors here, so you might hear some noise outside. Probably always in long, probably buyers below 24, probably at least a small second leg up. And for the bears, it's a small wedge, 1 pullback, 2 pullback, 3. Anytime you get a double top and a bull breakout and it reverses, you have 3 pushes up. The double top is formed by 2 pushes up, and then the breakout is the 3rd push. But the channel here is tight enough, plus 3 bull bars closing on their highs. Low probability sell, more likely buyers below. Any buy and any sell is good enough for a swing. So theoretically the bears could sell below 24 or below 25, but more likely there are buyers below, and that will go a little bit more sideways to up. Even though always in long, a lot of bulls are hesitant to buy closes because all the bars are small. I usually try to buy closes here or here, but because the bars are so small, I did not. So right now I'm waiting. Also, the size of the sell-off below 17 and then again below 21 is a sign that bears are reasonably strong, and that also makes me hesitant to buy too high in what I think is going to be a trading range. Still a pullback from the 23-24 breakout, but everything is tiny, and that makes it hard to make money. You need the market to move, and this is a very tight range. It's only 11 ticks from bottom to top, less than 3 points. Still, I think always in long, and I still think we'll get above the one low. Is it still always in long? I think so, but it would not take much to make it short. However, as I said earlier, I don't think it matters whether it's always in long or short. A lot of traders will not trade when the range is this tight, and the market's likely not to go very far. The bear's still hoping to get below yesterday's low to make it always in short, to make it outside down, but a lot of support here, repeated reversals up, 60-minute moving average. I am flat. Bulls trying to get a higher low, and the bears want to get the breakout. I think very difficult to structure a profitable trade here. Again, I have contractors at the house. That's why you hear some background noise. In general, I want to buy low, sell high, and scalp. But when the range is this tight, I often just wait. Are we still always in long? I think as long as we're staying above the 18 low, maybe the 22 low, it's slightly more likely that there'll be buyers down here. But I think most traders are better off just waiting. Can you sell on a stop below 18? Well, it's similar to buying on a stop below 19. Breakout mode market, but a lot of tight trading range trading. Yes, the bulls look like they're going to have a failed breakout, and it slightly increases the chances that the bears will have a successful breakout, but we're right at support. Sell-off trading range. Bears want trend resumption down. Here they got a little down, but they did not first have a failed bull breakout. The failed bull breakout helps the bears. Here, failed bull breakout, it increased the chances of a successful bear breakout. Can you sell here? 3 or 4 consecutive bear bars. It's a tight trading range, and we're at the bottom of it. I would not. I would wait to see what the breakout looks like. And even then, it's going to be really difficult to make money selling the breakout. By the time you decide the bears are in control, the market's probably not going to fall all that much. We went 9 ticks above. Is that 9 ticks? Yeah, we went 9 ticks above yesterday's high, and therefore there's support around 9 ticks below yesterday's low. Outside days tend to be fairly symmetrical. They tend to break out of one side by about the same number of ticks that they broke out of the other side. They don't have to be. Sometimes you can get a huge trend, and it's still possible this could be a huge bear trend. Unlikely that it would be a huge bull trend at this point, but the bears still have a chance at a huge bear trend. Unlikely, though. Probably buyers around yesterday's low, Friday's low. Remember, I said that there was an increased chance of a big bear day or a big bull day at some point this week because of what's going on with the higher time frame charts. Daily chart, we have a wedge. It's small, normally a minor reversal, but after a huge buy climax, it increases the chances that it could be a fairly major reversal. All right, little bulls buy right here. Bottom of a trading range, hoping for a double bottom, 18. Well, with the 5 bear bars and no bull bar and 9 bars, I think bulls will not take the buy. Bears trying to get the breakout, they're getting it, and they want to go outside down below yesterday's low, Friday's low. They'll probably get that as well at this point. Bulls want another wedge. They have a wedge with 16, and now the 3 pushes are 1 push up here, 2nd here, and hoping for a 3rd here, but way too many bear bars, so most bulls will not buy above 33. Big magnet below, Friday's low. What are the chances of a huge bear trend day? I would say maybe 30% chance. As I said, daily chart, the context is really good for the bears. Buy climaxes, daily, weekly, monthly chart, at major resistance, measured move on the daily chart, and now we have a small wedge after a buy climax on the daily chart. What can the bulls do to make traders buy the breakout? I think a lot of the bulls will want at least a second entry buy. For the bears who sold one tick below 18, it's a 5-tick trap. And if it was a strong breakout, you'd expect the market to quickly go down to 6 ticks. Sometimes when the market tries to become an outside down day, it gets very close to yesterday's low and then reverses up. Traded above yesterday's high, collapsed strongly, but failed to get below yesterday's low, reversed up. Look at this sell-off. Could not get below yesterday's low, went above yesterday's high, and with that kind of momentum, you'd think the odds were high that we would get below yesterday's low, and instead, we reversed up. Same thing. Well, this did go outside down. But anyway, this is an extreme example of how the market can get close to being upside down, and even with tremendous momentum, it still can reverse up. What happens when it does go upside down? Usually you get symmetry. Usually it goes as much above yesterday's high as it does below yesterday's low, but sometimes you get a huge bear trend day. I don't have any big bear trend days from it, but sometimes you do get a very big bear trend day out of it. Why is it most of the time you do not get a big bear trend day? Because it's sideways. We went up, we went down, went above yesterday's high, below yesterday's low. It's sideways. When you here, trading range day, usually the day before is a small day, trading range day. You get a failed breakout above. The odds are when you try to break out below, it will not get very far below either. Math here is interesting. All right, for the bulls, it's a wedge bottom, reversal up from above yesterday's low. We have a whole bunch of bear bars, similar to those examples that I showed where the market collapsed down, a whole bunch of selling, yet the market rejected the possibility of outside down and it went all the way back up to yesterday's high. So it's a swing buy above 35. Probability not all that high. It might be 30% that we got some kind of a decent bounce, maybe 40%. For the bears, can you sell the 35 close, sell the close? Well, look at the breakout below 18. It's a 1-tick bear body. That is not a very good looking strong bear breakout, and therefore a lot of traders are not willing to sell the close. Always in bears, I think they probably get out above 35. And bulls, in a situation like this with this much selling, the context is really good for the bulls, right? We're trying to not be an outside down day, but I'd like to see 2 or 3 bull bars and then buy higher. So buy after we see this, buy after we see 3 consecutive bull bars here. Not a lot of a rally, but still 3 bull bars here, outside down, micro double bottom, and then 3 bull bars, scalp, trading range day, scalp. Here we had consecutive sell climaxes. That makes this a little bit higher probability. Sell the closed bears probably get out above 35. We're still always in short. Maybe we went always in short somewhere in here, but a lot of trading range trading, by the time it's always in short, there's very little left to it before you get a reversal. I think the odds are against a big bear day. Although we're getting a series of bear bars, they're not big, and now we have a micro double bottom. So, a reasonable swing buy above 35, higher probability, wait to see if we get a few bars sideways to up. I think a lot of the bears will get out, most of the bears will get out above 35, similar to buying above 16. So now this is the potential wedge. For me, 3 reversals up makes a wedge. 3 pushes down with reversals up make a wedge. And I usually connect the first and third bars, and very often the second push down will fall below the line. And if the third bar if I connect the first and second bars and the third bar, like this, sometimes I'll draw it like this, use the first and second pushes, and the third will go far below the line. Bears trying to prevent the market from getting above 35 because they know a lot of bears will buy back their shorts and it could start a swing up. What about, it's an II, so what about selling below 36? 3 dojis at support, 60-minute moving average at yesterday's low. It's just not that strong a sell-off. So I would get out of shorts above 35, and I would wait for at least a couple pushes up before buying. Excuse me, a couple bars up before buying. Can you place a limit order to buy the 35 low, the 36 low? Yeah, my one thought about that is right here. The bulls who bought the 1 low did not make money. You have some bulls who bought the 18 low and or 1 point lower. They should make money. Usually if the first time, you get right up to the prior low but not above, the next time you get above the prior low. So the odds are we're going above the 18 low, which means above the 35 high, which means the bears buy back their shorts. But, the math of it, the probability of it going straight up, right now, maybe 30%, maybe 40%. So important, bulls who bought 1 point below 18 made money. So we got limit order, bulls making money and a bear trend. Reduces the chances that we're going to go a lot lower. Can this trend down all day? It's probably not going to happen. Tight trading range here. And then when the bear trend resumed, several of the bars only had 1 tick bear bodies, and some had dojis, and therefore there's not a lot of interest in selling as the market's going down. I'm sorry, the mic was off. 15-minute chart, rally up, reversal up, possible reversal up to a wedge, and the Globex chart breaking below the bottom of a trading range, and there's a head and shoulders top, left shoulder, head, right shoulder, but we're at a support area, not a strong buy, and the breakout is not very strong. Day session, when you look at that, you say, wow, what a great sell. Or do you say, it's a double bottom, slightly higher low. We tried to reverse up, trying to reverse up again. It's not all that bearish. For the bears, I think I would get out above 35. If you want, you can wait until there are 2 or 3 bull bars when it becomes always in long, if it becomes always in long. And it's similar to 17. Do the bears sell again on the first reversal down? Let's say 17 is a 2-tick bear body closing on its low. They might. I would not. I would wait for a second reversal down. Even if we do go outside down below yesterday's low, this is telling us that we're probably not going to go all that far. buyers or sellers, 36, 37 low. I think slightly more likely buyers below, and probably buyers below yesterday's low. But even if we do reverse, the first reversal is probably minor after this tight a bear channel, which means if we go up, we'll probably need some kind of a double bottom before the bulls can go very far. Bulls trying to get back to always in long. I showed those failed attempts to become upside down. Here, very big reversal up. Bulls are hoping for that, but today has much less energy than this day. Same thing, this day has much more energy, much more bigger bars, more likely to get big moves up and down. Same here, more energy than today. Bears probably will not sell below 39. Some of them are selling at the moving average. Here we went 4 ticks above the moving average, so these bears might sell at the moving average, put a stop 4 or 5 ticks above. Bulls probably will buy below 39 unless it's a 2 or 3 tick bear body closing on its low. Similar to this, I do not have the top of the channel drawn in, but probably buyers below. Bears are hoping that we just channel down all day and form a big bear day, but so many reversals, prominent tails here at a support level. We broke below this support, and now we're at another support level. When you look at this, you say, wow, what a good bear trend. But you say, kind of looks like we're going up in a broad bull channel. We have a couple legs down. We have maybe a double bottom here. Right now, slightly higher high, a higher low. And if it goes low, then a lower low, but does not look all that bearish. The always in bears, unless 39 suddenly closes down at the 38 low with a 3 tick bear body, I think the always in bears will not sell again. 5 tick trap for the bulls, but I think the bears want a second entry short. So also we have a potential low of the day. So I'm not opposed to being long. Stop below 35. If you get stopped out, you buy again. Probably buyers below 39. Probably buyers all the way down to the 35 low. Just like here. They bought below. And here they bought below. bulls want to buy below bars, below 18, below 40. Bears want to sell above. We're in the middle of the most recent bear leg. They're hoping for a bear channel, a series of lower highs. This is the sell zone. But now we have a 7-bar bull microchannel and probably buyers below 40. And the bears want to wait for the market to go sideways a little bit before they sell. What are the odds? Well, by the time we've seen bar 18, we have a 90% chance that we've seen either the high or low of the day. Since we went below 18, there's a 90% chance we've seen the high of the day. And that means that the reversal that we're getting probably will not get above the high of the day. It could get very close to it, but usually not all the way back above it. Here you can see traded above yesterday's high, below yesterday's low, and we got a big reversal, but could not get back above yesterday's high. Excuse me, could not get back above the high of the day. It did get above yesterday's high again. Where do the bulls buy? Well, 60-minute moving average. And then each of these little bar lows, the 41 low, 37 low, stop for the bulls below the wedge. So bulls will be buying all the way down to the 35 low. And even if we break below the 35 low, then the bulls will see another wedge, 1, pullback 2, pullback 3. So buyers below that as well. But the bears, they're in the sell zone, the middle of the most recent bear leg. And but the math is a little bit tricky. Bears always want to be selling in the middle of the most recent leg down. So here, stop here and take profits below. So right now, their reward is exactly equal to their risk. But I think the probability is only about 50-50. And that weakens it as a sell. You want, if the reward is equal to the risk, you want higher probability. And usually in a bear trend the probability is higher, but this is a special circumstance. We have a wedge bottom, we have a 7-day tight trading range. We're right around yesterday's low support, 60-minute moving average support. I guess this double bottom might slightly increase the chances that we'll go upside down. Trading ranges tend to fall below support before they reverse up. They tend to go above resistance, the double top, before they reverse down. And for the bulls, they have a 5-tick trap, 35, and a lot of them are getting out break even below 41. And other bulls will look to buy somewhere in the lower half of this, so somewhere down here. And those bulls might put their stop below 35, or they might hold and then buy a reversal up from lower, knowing that the bulls have bought the 18 low and bought more lower, made money. So there probably are buyers either at the 35 low or 1 point lower. Trading range behavior. Even though we're in a bear channel, most channels that are fairly broad have a lot of trading range trading in them. This is an example. Bears looking to sell in the middle of the most recent bear leg. So here, selling in the middle third of that bear leg. Here, selling in the middle third of this bear leg. But because of the wedge, the 60-minute moving average, the 7-day wedge bull channel, and mostly sideways for several days, bulls are buying, as in addition to the bears selling. Target for the bulls, the most recent major lower high, the 24 high. And it's possible they can get back to the high of the day. Right now the bulls are trying to get a reversal day, a sell-off, and then a rally for the second half of the day. This is around the middle of the day. And if it does become a reversal day, unlikely to become a big bull day, probably will rally back up to around Friday's high and not much more. A lot of the bulls want to buy a little bit lower after a 5-tick trap. Bull is trying to buy in the middle third of this bull leg. You can see we're right around a 50% pullback. Are we always in long yet? Well, I thought we were probably always in long on 23 or 24. And then when we fell below 22, maybe up to 4 or 5 bear bars, probably always in short. But when a day is mostly a trading range day, by the time it's always in long, it's about to reverse down. And by the time it's always in short, it's about to reverse up. Right now, I think it's slightly more likely that there are buyers around where we are than there are sellers. So I think it's more likely we'll go above 39 than it is that we'll fall below 35. And if we do fall below 35, probably buyers below, and buyers below yesterday's low. But we went 9 ticks above yesterday's high, so we could easily fall 9 ticks below yesterday's low, below the buyer, before the buyers come back. Do you feel like you're waiting all day? That's usually not the case in a trend day. While we're in a bear trend, it's probably not going to end up being a bear trend day. It's probably going to end up being mostly a trading range day. So probably not a lot of downside risk and not a lot of upside potential. You just feel like you're waiting for more information. And then when the market finally does something, it does not go very far. On a day like this, well, today in particular, I had 2 or 3 small buys or sells where I got either break even or with a tick or 2 profit. Here I bought, I just got out, but I bought with a limit order at 25.52 exactly, and I got filled on the low tick, which usually does not happen, but I did, and back to flat. Targets above the high of the 24 lower high, trading range day. So you're always going to be thinking that if the open is in the middle third, it's a magnet at the end of the day. You can see the past 2 days were doji days, and 5 of the past 6 days were doji days, closing around the open. And right now it looks like today probably will do that as well. Whether or not we go above the open, I think it doesn't matter. We'll probably close around the open. I scalped out, so that means I'm not willing to hold high, at least not yet. Low 2 is short in a bear trend, but probably always in long. Getting a little bit late in the day. Probably will get back to the open of the day. So probably buyers below 47. A lot of times in a trading range day, the market trades down for 2 or 3 hours and then up for 2 or 3 hours. So I think probably buyers below 47. And even if we go above the open, I think we'll probably close back around the open. Can the bears make money selling above 39 and above 24? Probably. The day is probably going to end up a trading range day. It's probably going to close within a point or so of the open of the day. Will we get above the 24 high? Probably will, but even if we don't, we're probably not going to fall very far. We're probably going to remain maybe in a 4-point range for the rest of the day, 2 points above the open, 2 points below the open, probably sideways for the rest of the day. Bear channels and trading ranges often have second leg traps where the market looks like it's breaking out, but the second leg traps bulls into buying high and then fails and the market reverses down. I think we're always in long. I think we have a wedge bottom. I think the odds are we'll get 2 legs up. This channel is tight enough, even though it's 2 legs, it's probably a first leg that's subdivided into 2 parts. And therefore, if we do trade down for a couple small legs, we'll probably still get another leg up. So always in long, not much downside risk, but still difficult to make money because we're not moving up very far. Even if we were to get all the way up near the high, it's probably not going to go straight up. Probably will pull back first. And even if it did go all the way up there, it would be only 3 more points. More likely, we'll get some bull profit takers around where we are and the 24 high. Maybe get a couple small legs down, and then the bulls will try to get another bigger second leg up. So first leg, pull back, and then second leg, and then end of the day, close around the open. We're in the sell zone. We're up 10 bars, and we're near a prior high and near the open of the day and yesterday's high, but too much buying pressure, I think, to sell yet. A bear III, slightly lower high 24. Might get a couple small legs down, maybe down to the most recent significant higher low, 45. I don't want to use the term major because we're in a trading range. Everything is minor, but the bulls failed to get above 24. The bears are trying to get below 44, but there are sellers above 24 and probably buyers below 44. And we'll probably end up closing around the middle of the day, around the open of the day. Because it's a low too short in a trading range day, 2 legs up in a trading range day, a lot of the bears will not take the sell. I think most bulls get out if they have not already scalped out, but they'll look to buy again if we get a couple small legs down to around the 45 low. A lot of the bear scalpers are trying to get out with 1 point, and they need it to fall 6 ticks. It probably will. And the bulls are trying to trap the bears. They're trying to get a 5-tick trap and a higher low. But trading range day, 2 legs down, likely. It's possible 50 is the first leg down, and then a triangle on a smaller time frame chart, and then a second leg down. But more likely, this is the first leg down, and then we get a pullback, and then a second leg down to around the 45 low, and there are probably buyers there. We may end up in a triangle for the rest of the day. We have a lower high, and if we get a higher low, we may just go sideways for the rest of the day. I still think we'll probably get back to the open of the day at this point. The bears had their chance to get a big bear trend day, and this was what they did. They got a series of bear bars, but all 1 or 2 tick bear bodies, prominent tails. They were unable to turn it into a trend day, and therefore I think it's probably going to remain a trading range day. The bulls have a reversal up, and they have not done enough to convince traders that it's going to be a bull trend day. So neither the bulls nor the bears are strong, and the result is probably trading range for the rest of the day. Is this 2 legs down, or is it the first leg of a deeper pullback? Right now, I think it's probably the first leg of a deeper pullback, but if we go sideways here for 3, 4, or 5 bars, traders will begin to believe that the 2-legged pullback has completed itself. First leg down, bar 50, we went up and down on 50, then we went sideways for a few bars, a tight trading range, and now having a second leg down. For the bulls, a small head and shoulders bottom. Bull flag, left shoulder head, and then right shoulder. But remember I said we might get a couple legs down from this 2-legged rally. Trading range days often have 2 legs up, 2 legs down. and the bears are trying to get a second leg sideways to down. And even if the bears get a double top, break below the neckline, measured move down, we're still probably have a hard time getting far below yesterday's low. The best the bears probably will get is a bear leg in a trading range. The opposite is true for the bulls. We're having a reversal up from the low of the day, but it's weak, and most reversals result in trading range days. This one will probably remain a trading range day, and will probably close around the open, and therefore probably not going to go up very much, probably not going to go down very much. Small triangle, 3 pushes down, 54, 61, 64. Breakout mode. Every head and shoulders bottom is a triangle. It may not look like one, but every head and shoulders bottom is a triangle. Every head and shoulders top is a triangle. And in breakout mode, only 40% chance of a swing up from here, 60% chance of not a swing up, which means either sideways or down. The chance of a big sell-off from here is small. Most likely, we're going to remain sideways for the rest of the day and close within a point or so of the open of the day. This range has been less than 2 points for over an hour. I usually stop trading when that's the case and just wait and look for something where I feel like there's enough movement to allow me to make money. I think we're always in long. If I were doing anything right here, I would be long, or I'd be buying below bars, but the range is just too tight. We could easily come down to the 45 bottom of this buy climax low before we go higher. So I'm going to wait. Also, we're very close to the target, the open of the day. Bull body, triangle, just above the moving average, with the target, the most important target, open of the day, is just 4 ticks above, and you need 6 ticks for a profit, for a 1 point profit. So if you buy above 65, you're risking 6 ticks. You buy 1 tick above, stop 1 tick below to make 4 ticks. Let's say you're scalping for 1 point. Does this look 70% likely to achieve your goal? I don't think so. Just because something is probably going to happen does not mean the probability is big enough to offset the bad risk reward. And this is a good example. Is the market probably going up? Yes. But is it probably going up enough to offset the bad risk reward? I don't know. You probably need 70%. And for a stop order buy in the middle of a tight trading range, in the middle of a trading range day, I think it's not a 70% certain. The actual risk might only be 3 or 4 ticks, right? Let's say we just go straight up from here. Then you actually only had to risk to 1 tick below 66. So 4 tick risk or 4 tick profit. And even then, I'm not convinced that the reward is worth it, because you still have to go up 6 ticks, and your actual risk would then be, 4 ticks. And I don't think the probability is high enough for a stop order scalp. You can always scale in. However, we're getting late in the day, and if it goes above 65 and then below 65, I think traders will then think we make it down to the low of the day rather than reverse up again. So I think it's really difficult to take this buy, even though I think we're always in long, and I think it's slightly more likely that we're going up than it is that we're going down. The bulls who bought about 57 have 6 ticks, but the bulls who bought above 65 do not. I still think the odds are they'll get it, but I also think, as I said, the math is really difficult. You'd have to sit through a little low 2, low 1, low 2, and the odds of it going very far up are small. The bulls are hoping for a buy the close finish, but more likely it'll be like what we had the other day, where, you know, it tries to get above, over here, tried to get above the open, tried to get below the open, and came right back to the open again. So probably we'll have a hard time going much more than a point or two above the open, just like the bears will have a hard time getting a point or two below the open. On these late tests of the open, most of the time the market gravitates toward the open, but sometimes in the final few bars it gets up to the high of the day, and on the daily chart you get a bull trend day, and other times in the final few bars it sells off to the low of the day, and then on the daily chart you have a bear trend day. So if the bears close the day on the low, we have a wedge top, 1, 2, 3, 4, 5 different ways to count it. If the bears close it on the low, so if this suddenly closes down here, that would create a more credible sell signal bar on the daily chart. Even though it might not look like it, we should go one tick higher. We're 16 ticks above the 36 high, and when it goes 16 ticks above a reasonable buy signal, 90% of the time it goes 17 or 18 ticks above. I don't know if that statistic holds true in the final few bars of the day, but the odds are, you know, certainly better than 50-50 that we're going to go up at least one more tick. It was a predictable day, but not much movement. Daily chart, huge breakout above the top of a channel a few weeks ago, and now we have 7 days up in a fairly tight channel with multiple reversals, so it's a small wedge, and normally that would be completely minor, but the context makes it more significant, and the breakout point is right here, which is around 2,500, and I think that's a reasonable first target for a reversal down. And as I said, normally you'd look at this and say, it's no different from that or this, and the market just keeps going sideways. Same with here, keeps going sideways. But the one thing that's different is it is a small wedge, and it's after an extreme buy climax, and we're very close to, I think, a very important price. And the bulls know the price is important, and the bulls would like to break strongly above it. However, because the weekly and monthly charts are so extremely overbought, I think it's more likely that will reverse down at least to the 2,500. Plus, it's the end of the year, and the year has gone straight up, which is very unusual. Here's the start of the year. Here's the start. This is the weekly chart. So the year started back here, and those significant pullbacks, really, really unusual. On the monthly chart, 12 bars without a pullback. That's only happened once in the past 50 years in the S&P, and that time it went 13 months and then had a pullback. And here we have 12 months, and nothing, you know, I don't know how many times it's gone 12 months. I think this time and that other time it went 12 months, but I think no other time did it go 12 months. And going even 8 or 9 months is unusual, even here. You know, it's about 8 months, and then, you know, another 8 months. You know, here it's 4 months. You know, a strong trend, but still got pullbacks along the way. So monthly chart extremely unusual, weekly chart extremely unusual, and now the daily chart, you add to it the breakout and the I want you to look at this. Okay, we got a bull channel, and we have a bull breakout, and then a wedge. Right now we have about 7 bars up from the low. So look at this, breakout, small wedge. And then look at the weekly chart back in 2003. Let's see if that's the monthly chart. Let me go to the weekly chart. Market is trying to top out here, top of a channel, and then the weekly chart has a breakout very similar to the daily chart's breakout now, and then a small wedge. and then we got a big bar down, and we traded down or sideways down for about 30 or 40 bars. Anyway, this is the weekly chart down there. And this is the daily chart. This was a strong breakout. We have a strong breakout. This was a wedge top. Should be a minor reversal, and it was. It led to a trading range, but the trading range lasted 40 or 50 bars. And we have a small wedge here, small wedge there. You can far above the moving average here, far above the moving average here. So you can see there's a lot of similarity. So this is a breakout above the top of a bull channel. This is a breakout above the top of a bull channel. Very big buy climax on the breakout, very big buy climax, wedge top, and then this went sideways for about 40 bars. Here's that area that I just highlighted, and it did this for about 40 bars. That's actually a 10% drop as well. You know, I don't know that we're going to get a 10% drop on the daily chart, but I think there's probably not much left to this rally. You know, I've been talking sometime over the next 1 to 3 months. I've been saying that for 6 months, and now it might be sometime in the next few weeks that we finally get a pullback. Also, we're getting near the end of the year, and a lot of bulls will look at this year and say, wow, this is an incredibly unusual year. It's gone straight up. Maybe I better take some profits at the end of the year. So I think there's that factor as well. This is a fairly common pattern where you got a gap up and a deep pullback and then a wedge bottom. You know, I showed 2 or 3 examples of that this morning, and it often forms the low of the day. The bulls tried to do it here. Wedge went up, and this reversal up failed, and then it became a bigger wedge here, and this became the low of the day despite 6 consecutive bear bars. Micro double bottom, 60-minute moving average, higher low below the bottom of the rally, and weak bull channel, and a reversal day. We went down, we went up. And usually reversal days do not become big bull trend days, especially if the initial sell-off is big like this. Usually you get up around the open, sometimes you get up to the high, sometimes a little bit above the high, but has a difficult time getting much higher. Do I still think we're going 1 tick higher? Yep, I still think we're going 1 tick higher. So, you know, even though we're getting a bear bar here, I know the math. You know, the odds are we're going 1 tick higher. So it might go 2 ticks higher, but I think we're going at least 1 tick higher, even though, you know, we've got a small wedge here, we got a breakout above a double top here, we got a spike in channel here, and we got a magnet of the open of the day here. That is all true, but I know the math. We're 16 ticks above a decent buy setup. You know, the odds are we're going up at least 1 more tick. For stop entries today, the first one that I thought was reasonable was below 5 for a possible high of the day, failed breakout yesterday's high. And I said that yesterday was a small day, Friday was a small day, and therefore we may even go upside down today. We may reverse down from above yesterday's high and then break below yesterday's low. And if we do, the breakout would probably be about as big as it is up here. So 2 points up, 2 points down, and probably some kind of a reversal at that point. And if we get the reversal, probably a channel that lasts several hours, but probably not a new high of the day. Or if it gets to a new high of the day, the new high will probably be small. We're probably not going to go a lot higher. So the bears are sold here. Got a bear micro channel for about 10 bars here, and then a lower high. Bulls tried to get a reversal up on 22, 23, 24. The market was probably always in long, but the probabilities were not as good as the bulls would like because it's a breakout above a tight channel, and we did not accelerate up all that far. So it's probably more of a bull leg and what will become a trading range, and this is probably a minor reversal. I thought it was interesting that we could not get above the 1 low. And the bulls tried here, they tried here. I thought that was interesting. It made me think that we might come down and get a third leg down before we get the reversal up. So stop entry selling below 5 made sense. It fell 18 ticks down to 16 and then had a double bottom. At that point, it was a wedge with 1, 11, and 16 with a decent buy signal bar, but tight channel, 10 bar bear micro channel, probably a minor reversal, but it should go up enough for at least a scalp, which it did. It barely did. It went up 6 ticks, 24, and not that easy to hold short. The market reversed down below 17, and then we have a low two short at the moving average 21. I thought we may go down for a third push at that point, but we went up a little higher and then had the third push. 24, always in long, probably buyers below, but is the probability high enough for a buy scalp? Given the risk and reward, that's a problem. If you buy the 24 close or the 24 low, stop is below 22, okay for a swing, but we're probably not going up all that far. And for a scalp, it's probably not good enough because you're risking more than your reward, and the probability, even though it might be 60% that there are buyers below, you probably need 70 or 80% because your risk is more than twice your reward. Buy the closed bulls, 24, disappointed 26, tried to get out, break even 27, and look what happened. 27 tried to get back above the 24 close and it immediately reversed down. That increases the chances that we'll sell off. And then the buy the closed bulls 24, a lot of them gave up here. Not all, some will hold and buy more at the low of the day or on a reversal up. So for example, you buy the 24 close, you buy more above a bull bar, 35 or 37, and then you hold for it to get back up there. It took all day to get there, but eventually it got there. Stop entries here, so I'd buy here. I think the bears get out above 16. I don't think they sell below 17. They can sell below 22 for double top with 12, low two short with 17, but only a 1 tick bear body. So it made me think that we might be channeling up. And the bears, do they sell again below 26? I think the bulls get out below 26, and maybe the bears sell. I think we're not going down all that far. And I think if we do fall below 18, probably buyers below, even though we have a gap, 1 low, 24 high. And then next stop entry buy above 36 or 37. Some of those traders are wedge bulls buying the wedge. Others are buying the failed breakout and then the double bottom 78. And then others are buy the closed bulls 24 scaling in lower, or traders who see this as buy the close and they're looking for a bull bar. Even if they did not buy the close, they're looking for a bull bar to buy above, expecting it to get back up there. And then probably buyers below 43. If you buy above 44 or 45, stop below 34, might get a couple legs down. And then selling below 63, it's an I, and a double top 24, but a tight bull channel, probably buyers below. This wedge bottom, I said we'd probably get 2 legs up, and I thought the rally to 50 was 2 legs up, but the legs were too small, and therefore it's probably the first of 2 bigger legs up. And then, so we got 1 leg up, and then sideways a triangle, and then a second leg up. Stop entry buy above 65, okay for a swing, not a great scalp. You can see we finally got 17 ticks above 35. That was fairly predictable. Buy the close, sell the close. Well, the first one that I would consider would be, maybe 8 and then 10 or 11. 11, we had that big tail on the bottom, and it made me think that the odds were against a bear trend, and then we had all these other tails. So we're probably either forming a bottom or we probably have 1 more leg down and then form a bottom. Buy the close, 23, 24. We're probably going higher, so it's okay to buy it for a swing, but I would not buy it for a scalp. And if I bought it for a swing, I would be concerned by 26, and I would probably get out below 26 or below one of these bars and just take the loss and then look to buy again on a reversal up. Is it buy the close 38, 39? Well, I don't know. We're probably going higher. It's the same with 46, 47, 48, 49. It's a trading range, so we could get a very deep pullback. but the odds are we're always in long, and we'll get a second leg up. Limit orders, I thought there were probably buyers below 12, despite the big bear bar and the consecutive bear bars and the big bear bar here. We're at the 60-minute moving average. Big tail, 11, so I thought we were going to enter a tight trading range, which we did. So buyers below, nobody's going to sell the 16 high. Well, that's not true. I'm not going to sell the 16 high. I think we're probably going a little bit higher. And you can see they placed buy limit orders at the 16 low and one tick above the 16 low. And then bulls bought for any reason, looking for either a swing up or at least a test of the one low. When we were down here, I said I thought the limit order bulls at the one low would make money, even though there was a big bear breakout and follow through. That big tail and then these repeated tails made me think we would get back above the one low. The bulls tried here and unable. What about limit order trading here? I think buying below 17 made sense. I would not take the buy below 21 because it's a low 2 below the moving average for the bear bar. And I think the probability is not high enough for a scalp up. And then what about selling above 28? I thought we might go sideways and try to get a second leg up, but we did not. So I would not sell above 28 and I would not buy below 24. And then here, big tail below 34. And looks like the bulls bought the low of the day, the 18 low. It looks like we're trying to go form a wedge bottom. Probably buyers below 41. And this channel is so tight, I thought we were not going to fall all that far. It's possible we could fall below 45 all the way down to the low of the day. But I thought there would be buyers below 53 that were always in long. Tight trading range here. I think too tight for most traders to bother trading unless you're willing to hold for a swing. And even if you did, you got only a couple points. I would not be shorting here. You can argue double top here and here, a triangle, 1 push down, 2 pushes down, 3 pushes down. I think we're always in long, and we'll probably try to get back above the high, the all-time high. I thought we probably were going to close back at the open of the day, but we closed a little bit above it. And daily chart, it's a small bull body, but it's still a bull bar. So even though the market is way overbought, and there are all kinds of reasons for it to turn down, there's no credible top yet, and there's no big reversal down yet, and therefore bulls just keep buying, and they'll keep buying until they start losing money. And they've made a lot of money this year just relentlessly buying. Now we explain a little bit more about the 16 ticks. Yeah, if the market has a credible buy setup, here we have a wedge bottom at support. The bears failed to get outside down, so we're probably going higher for a swing. And we have a decent buy signal bar, 35. Whenever you have a decent buy signal bar and decent context for a swing, and the market has to go up 18 ticks for the bulls to make 4 points, 16 ticks. They buy 1 tick above 35, and it has to go up 17 ticks from there for them to make 16. So it has to go up 18 ticks. And a lot of times it'll stall at 17 ticks, just like there are 5-tick traps. Bulls wanting to make 1 point, they need 6 ticks, and you get 9-tick traps. The bulls need 10 ticks to make 2 points. There are also 13-tick traps and 17-tick traps. However, if the market is on its way for a swing, minimum swing 4 points, and it gets to 16 ticks, there's a 90% chance that it's going to get at least 1 more tick. So even though it kept trying to reverse down here, I knew that the math was so much against it that you can't sell. However, you may only go up 1 or 2 ticks, and therefore it's hard to buy. And you can see we went up to 18 ticks above 35. And it's the opposite of here. Selling below 5, the low of the day, it fell 19 ticks. So the 4 point, no, right here. This is, I'm sorry, this is the low of the day. This swing down was 18 ticks here. And this big tail in part was a lot of the bears got a quick 4 points, and it's one of those magic numbers. You know, if you're scalping in the E-mini, 4 points, take profits at 1 point, 2 points, sometimes 3 points, but the most popular profit targets are 1 point, 2 points, and 4 points. So you tend to get bounces at 6 ticks, 10 ticks, and 18 ticks. And that's what happened here. 18 ticks below there, we bounced up. All right. Weekly chart. Last week was a small range week, and we've had bad follow through over the past 6 or 7 weeks up. So there's an increased risk that this week will be an upside down week. We're above last week's high. Last week was small. So there's an increased risk that we're going to trade down like this, trade above the high of the prior week, and then reverse down and close below the low of the prior week. And, right now, there's an increased chance of that. If we start to break strongly above where we are, the odds go down. The single most important price on the chart right now is 25.59.5. And we'll probably get there tomorrow or the next day. And it's the most important price because we have a major higher low on the daily chart. We had a major high right here, and we broke above it, and we tested just a little bit above it, and then we went a little bit above it and tested a little bit below it, and then rallied very, very strongly. So the market clearly considers this a very important price. This is clearly a very important price, and that means a measured move up using those two prices is a very important price. So 25.59.5. Okay, hope everybody has a good night.